All right, it looks like just about everyone has joined, so we'll go ahead and get started. My name is Jessica Ballard. Today our host, Peter Brown, will be discussing how to help your business clients win loans. I'm going to run through a few housekeeping items before we get started. During today's webinar, you will be in listen-only mode, so no need to worry about any background noise on your end. You should have received a link to the GoToWebinar panel. And on that screen, we encourage you to ask questions throughout the presentation, and we'll do our best to answer many of those at the end if time permits. To ask questions, just please utilize the GoToWebinar panel on your screen where you may be able to type those in. We will have a couple of live interactive polls that we encourage you to participate in. Again, this will be accomplished by clicking on your selection when the poll question is shown. All right, before we get started with the webinar, I want to give a little history of Sageworks and how we got where we are today. Sageworks started because we recognized small business owners had a hard time making sense of their financial information. Essentially, these businesses have difficulty understanding what they receive from their CPAs and how these financial numbers connect with their operational performance. We began with our product line ProfitSense to help translate financial performance into easy-to-understand narratives with charts and industry benchmark comparisons. We began providing our tools to CPAs to help deepen relationships with their clients, catapulting them into trusted advisor for their business clients. After providing these solutions to the accounting market for about 10 years, we started having financial institutions banging on our door. What had taken place was that CPAs were providing their business clients with our ProfitSense reports, who were in turn giving these reports to the banks in search of capital needed to grow their business. The bankers recognized how helpful these reports were in assessing the loan worthiness of a business. This spawned our financial institution division here at Sageworks. The former head of the FDIC, Bill Seidman, came on board with us as a consultant and investor in order to help us create a suite of tools around risk management solutions. We now have about 800 financial institutions that utilize our solution, ranging from $20 million to $20 billion in assets. Next, I would like to provide some information on our presenter, Peter Brown. Peter is a consultant here at Sageworks. He brings experience in technology, business, and financial services into his role. Peter successfully navigated the challenges of running a small business in a competitive marketplace. Here at Sageworks, he uses his unique background to provide superior advisory services to Sageworks clients. All right, Peter, I'm going to go ahead and turn it over to you to begin.
Great. Thanks, Jessica. Appreciate the introduction. Thank you to everyone for joining me today for the webinar. I'm really looking forward to the topic, which I think is quite relevant to CPAs across the United States, in fact, all of North America. I get questions about, helping with loans all the time from the clients that I work with. So today what we're going to discuss is really how you as CPAs and financial professionals can help your clients win loans more effectively. Now, some of the key lessons that we've learned here at Sageworks through our time working with financial institutions and with CPAs, all types of financial professionals, there's really three key stages that are crucial for winning business loans. So qualification, quantification, and presentation. So for today's webinar, we're going to look at what it means to help qualify, quantify, and then present meaningful loan analysis for your business clients. So some of us may be thinking, well, yeah, but I don't currently offer this type of service. That's okay, because you as CPAs are really uniquely qualified to help in this exact area. Accountants are really in a unique position. You already have your clients trusting you with a lot of sensitive information. You also have the skill sets and background necessary to analyze this information and really present it in a way that's meaningful to these banks. So in addition, a lot of CPA firms have good relationships with creditors. So you know the kinds of information that's necessary for the banks. Finally, you are able to provide an objective, unbiased perspective that really is invaluable for these business owners, especially many small businesses that don't really have the resources or background to wade through the loan process by themselves. So there's really three main reasons, so what, why is this important to me, that that we've seen and heard from our clients. One is that you as accountants are expertly qualified to provide this type of business advice, and again, particularly to small business owners. Number two, it really deepens the relationship with your clients. And of course, it can actually generate additional revenue from your client base. And finally, by helping your clients kind of work through their needs for capital, you're going to help them survive, and not just survive, but rather thrive. And you can be confident about their satisfaction, as well as obviously their ability to continue to pay you for your services. Now, with that said, recently got some feedback from a couple of our clients in regards to just exactly this situation. Jeffrey Lewis, a partner at the Bonadio Group, said, CPAs often have strong relationships with multiple lenders and significant experience with various transaction structures. So CPAs can shop a loan to multiple lenders and create a situation in which lenders compete for the business. Also, Doug Lovett from Geffen Mesher told us that a majority of the roles for accountants in the loan process is really helping the client evaluate the terms and then coaching them through the negotiation process. Now, before we start talking about loans, I want to just think a little bit about the types of sources of funding that businesses can obtain. Now, of course, sales is the first and most important one. Revenue coming in from the business is really what's going to sustain them over the long haul. But in the meantime, they may need to get something to get over a hump, maybe to get started up with their business, or maybe just meet their working capital needs in the short term. Of course, for startups, the government is about the only source of funding that you can get free money in the form of grants. So always keep that in mind when you're helping small business clients, especially in startup mode, where they can actually get decent amount of money from the government directly. Secondarily, maybe angel investors or venture capitalists. And these, of course, are going to generally require some form of equity in the business. Now, this obviously can provide a great channel for capital. At the same time, it's at a big price. Imagine it's basically like a marriage, right? You're committed. You're now in this committed relationship with that investor, which obviously has its price tag. So today we're really going to be focusing on loans. And whereas with equity or with grants or with the revenue, the loans are actually a great source of funding for businesses, as we're all aware. We really wanted to share some of the best practices we've learned working with CPAs, consultants, CFOs, and then, of course, financial institutions to really talk about a topic that's really appropriate for our client base. With that said, I believe, Jessica, we have the first poll question.
We do. Thank you, Peter. Our first poll question today that we encourage you to participate in is, why do you think, or what do you think the number one reason is for why businesses fail? Oh, I'm sorry, Peter, we did the wrong one first. Okay, so the first poll question today is, are you currently offering loan analysis services to your business clients? For those of you that are just listening in, it is a yes or no question. And again, it is, are you currently offering loan analysis services to your business clients?
.81% of votes.
All right, we're going to give it just another minute here. We have a few more selections coming in. All right, we'll give it just another 10 seconds here. For those of you that didn't vote, you have a few more seconds to do so. All right, Peter, I'm going to turn it back to you to show the results.
Great. Thanks, Jessica. So it looks like we have a pretty solid, 1/3, 2/3 or so. 37% of you said yes, you are providing these types of services already, and 63% have said no. Now I'm going to just hide the results here. So it sounds to me, based off of kind of the poll here, that a lot of you already provide these types of services. That's great. Really look forward to hopefully honing some of your skills here. And then for those of you who are not currently offering these services, maybe it's a great opportunity for you to kind of learn how you can add some additional revenue to your firm and of course value to your clients. So at this point, let's kind of move into the topics. As we discussed earlier, the first fundamental that we're really going to talk about is qualification. What is it going to take to qualify your clients, their needs, etc., and helping them assess their needs in order to get the right loan for them? So we're going to really try to want to get a strong understanding of the who, the why, the what, and the how of their situation. So the first question really is, who are our clients? And of course, the obvious answer here is our business clients. But more specifically, in particular, it's primarily these small business owners, the ones who really need this kind of help in order to be successful. So working with small business owners, I'm sure that you all know, not only that they're kind of the backbone of the U.S. economy, but also working with them can be quite challenging. Even though they are small business owners, they often have these big dreams, kind of like the Titanic. It was a visionary idea that created a massive, indestructible ship that would have all of the amenities of a 5-star hotel for transatlantic voyages. The only problem that we all know is what actually happened to the Titanic. The ship was perfect in idea, but the execution had some difficulty. When it hit an iceberg, that grand vision didn't mean so much anymore, and the ship went down. Now, many of our small business clients are like that Titanic. They have great dreams, a great product, a great idea, but often their businesses hit some sort of unexpected iceberg. And they don't have the sufficient capital in place to weather that storm. In fact, a recent survey performed by the SBA shows that over 50% of small businesses fail within the first 5 years. Now, for this survey, the Small Business Administration was including businesses with 500 employees and less. So I can guess that many of you on this webinar have a large percentage of your clients falling within that category. This means not only do your clients have difficulty, but ultimately it's going to impact you and your practice as well, as they struggle to stay afloat and potentially even go under. So the second question that we really need to qualify when we're thinking through this is, what's really the problem? So in order to find the correct solution, we have to figure out what the real problem is. At this point, Jessica is going to ask the second poll question.
All right, so back to the first question that I was trying to ask earlier, because I think it's very important that each of you are aware of this, is what do you think the #1 reason is for why businesses fail? For those of you that are listening in, I will go ahead and go through the possible answers. The first one is lack of experience, poor location, insufficient capital, or market changes. And we'll go ahead and give it just about another minute here. All right, we'll give it just a few more seconds here. All right, it looks like everybody has selected. Peter, I'll let you go ahead and go through the results.
Okay, great. Thanks, Jessica. So let me post the results here. Looks like we had 0 for poor location and 0 for market changes. we had 19% for lack of experience, and then 81% of you all said insufficient capital. Now, I might have been setting you up for that answer, I'm not sure, but it's actually really interesting to hear your feedback and you who work with these business clients day in and day out. And it sounds to me like most of you recognize that insufficient capital is a substantial problem for these small business owners. Let me, okay, and if we move back here to these slides, Michael Ames, a consultant in the industry, wrote in his book about small business management that there's really 8 key things that are the biggest difficulties and biggest causes for failure for small business owners. And interestingly, you guys hit on the 2 top ones. In fact, the number 1 issue is lack of experience. And of course, that plays into the financial performance and health of the business. But secondarily, I think most of you got the number 2 answer there with insufficient capital. Now, if we look at this list, what's really interesting and what jumps out at me is that 4 of the top 8 are financing related. And from my experience, this is really consistently true with small business owners. Many, if not most, are struggling because some sort of issue revolving around their need for capital. So with that said, as we think about another study that was done by the Kauffman Foundation, 75% of small businesses funding comes from banks in the form of some form of loan, which is really meaningful because obviously there's all these other sources of funding out there, whether, as we mentioned, grants, investors, etc., maybe even family members. But the primary source of funding for business owners comes from banks. So it really shows how crucial it is for business owners to be able to successfully win loans from banks. Now, kind of coming back to the qualification, I think then let's think about what do they really need. Why do they need this loan? What is it that's driving this need for this working capital, this long-term loan, etc.? Now, in this context, I think it's really crucial to think about where the business is in kind of their cycle. Are they in startup mode? Are they in growth mode? Or maybe there's some changes ahead. So, a startup company, obviously the need for loans in all different forms is quite obvious. But maybe they're looking to expand their operations. Maybe they're in growth mode. Maybe they're looking to buy a new location. Maybe they're looking to expand across states or internationally. Or maybe there's just some sort of major change going on ahead. Maybe they're looking to retire in 5 to 10 years and they want to pass the business off successfully. And in order to sell that business, they need to get some sort of loan to actually become more successful. So there's a variety of different major driving reasons. And until we recognize what those reasons are, we can't really effectively match them with the right type of loan. Now, some of the other specific needs, of course, are stuff like, purchasing real estate or equipment, inventory, or maybe even just increasing working capital. Now, with that said, all of these different specific needs tie in some way or shape or form to what their overall strategy is. So it's really crucial to understand, what's going to help get them strategically to where they want to be. And now, of course, how do we match the needs with the loan types? So, these are some of the different types of loans. We're all familiar with this, but just really wanted to briefly, talk through these and make everyone aware of the different types of loans and really then the impact on the business owner. So, of course, the first one is the Small Business Administration loans. They back small business loans through local banks and agencies, and they can be used to buy equipment, inventory, furniture, supplies, etc. Really all-purpose type loan there. Of course, next we have credit cards. And a lot of small business owners may even be using a personal credit card. Now, of course, ideally, hopefully they're using a business card. And, you know, credit cards are very convenient. That's why we all use them, right? Essentially, it's a revolving line of credit. However, this convenience is really costly often. Cards typically offer high interest rates and with limits that are really just around $15,000 or so on average. Now, in order to, you know, get the best information from your clients, they're obviously going to have personal and business credit scores. Excuse me. And like most lines of credit, you know, this isn't something that businesses should overly rely on. It really should be just day-to-day type purchases that the business will easily be able to pay for at the end of the month. Now, of course, we have our line of credit, typically 90 days to a couple years as far as the term, and you know, they can be extended, of course. Maximum amount typically anywhere between $10,000 and a few $1,000,000. The interest rates, of course, float and whatnot. Now, these types of loans are typically meant for working capital needs. Again, your client really needs to be careful to not overextend themselves and their business by drawing out too much money that they can't pay back. Now, the last, you know, traditional type loan we think of is the commercial loans. And there's really two different types, short-term and long-term. And although the short-term loans are often used to finance things like operating costs, you know, working capital, they're not really interchangeable. A commercial loan is typically taken out for a specific expenditure, and a fixed amount of money is borrowed for a set period of time. And again, we're not saying anything that you guys aren't already aware of, but it's really crucial to help your clients know all this information. Now, what the main difference between a line of credit and the commercial loans is that in most cases the banks are going to require, you know, a substantial amount of documentation. They're going to require some collateral and as well as a reasonable cash flow and regular sales history. And then, of course, the main difference for the long-term loan is that they're going to, you know, the bank's taking on a lot more risk. So they're going to require a lot more stringent qualifications here. So if we could kind of summarize this section about qualification, I really think there's kind of three things to take away from this. You as the kind of trusted advisor for small business owners really can enable them to determine the direction they want to head. You know, it can be very confusing for business owners not only why they need the loans, but what kind of loans they need and what the impact is going to be on their business. Secondarily, protecting them from bad decisions. You know, ultimately, the business owners are, you know, very adamant about, you know, their product, about their service. They're experts in that field, but they're not financial experts. And that's where you come in as that trusted advisor to really help them steer clear of cliffs and things that they could really dive in you know, above their head. And the last thing is ultimately matching the right loan for their needs. And that's where you as that you know, experienced financial professional can help match their needs up with their goals and the types of loans that are right for them. Now, most of the clients I work with get that, and they also get the quantification. You know, when I say quantification, we're talking about the financial performance of the business. But the business owners often don't. And you guys, more than anyone else, probably know this. A lot of times, business owners' books are a mess. They have receipts missing. They have receipts thrown all over the place. Their numbers are all wrong. They have accounts in the wrong place in their ledger, et cetera, et cetera. More importantly, though, they may not even be able to quantify their actual capital needs. That's where you as the trusted advisor really fit in. So, you know, the first part of this is, of course, a typical financial statement. Now, when I say financial statement, a lot of CPAs immediately think income statement and balance sheet, and that's correct. But for banks in particular, they're really going to want to see a cash flow as well. Now, you as financial professionals understand these financial statements, but the question is, what about the business owners? Yeah, they all understand, generally speaking, a P&L, and they might even understand a little bit about the balance sheet, a little bit about assets, a little bit about liabilities, and even their cash flow. But do they really understand what it is and why that's relevant? I think it's really helpful to break it down for them in simple terms. Essentially a financial statement is a standard way to measure and track performance. And when you put it into simple terms like that, nearly every business owner can understand that. Instead of talking about dollars and cents and numbers and percentages, really take that step back and help them understand why this is important to their business performance. So, breaking it down then, we have an income statement. And what is this really doing? Well, it's measuring their performance over a defined period of time. The balance sheet, conversely, is measuring that performance at one discrete moment in time. And then finally, the cash flow. It's really measuring the changes in the income statement and balance sheet and how that's affecting this client's cash position. Now, of course, if they do have a good handle on their financial statements, more than likely they don't have a good understanding of key financial metrics. So, for example, what is a current ratio? A lot of our clients that we work with, really, business clients really have a difficult time understanding not only what it is, how it's defined, but also why is it important. And so that's why it's really crucial for us as the trusted advisors to really break this down into simple language. So, essentially a current ratio is a measure of whether or not the business has enough resources to pay its short-term debts in the next 12 months. And break it down in simple terms so that they can understand. What is working capital? How does it all work together? And then, even more importantly, is my working capital appropriate for the industry I'm in? So, if we think about somebody like a manufacturer or a retailer, wholesaler maybe, they're going to typically have a positive working capital. Their current ratio is going to be greater than 1. But what happens if they have a negative or less than 1 current ratio? Is that going to prohibit them from getting a loan from the bank? Well, very likely, but maybe it's also because their industry is actually, that's kind of the norm. Typically restaurants, hotels, airliners have a current ratio less than 1. And it's really crucial to know that when the business owner is looking to get these loans from banks, when the bank is maybe expecting a certain greater than 1 current ratio. A couple other key metrics that, of course, we're all aware of, and my favorite one is EBITDA. In fact, I think all of you guys have come to love this term. It's a great metric here. But how many of your clients actually understand this? Do they even know what it stands for? No, of course, the larger, more sophisticated clients do, the ones with CFOs. But what about those business owners who just have this great idea? Most of them are not really going to have great, competence in understanding what EBITDA is. Now, some other metrics, of course, banks are going to care about is stuff like interest coverage ratio. And then, kind of the crucial one is debt service coverage. Now, currently, back before the recession, a lot of banks were giving loans out at, right around 1 for the debt service coverage. But, because of the recession, banks are being a lot more cautious, understandably so. And most banks that we work with, as a minimum, are at approximately 1.2. So 1.2, 1.3. Now, ideally, they're really looking for about a 1.5 as a minimum. So if we think about, this quantification, you already have access to the necessary information to really quantify not only their needs, but also their ability to service the debt. So as we kind of wrap this up, a couple of things jump out to me. One is you are in a unique position to really help educate your clients, frankly, help them understand what their needs are and how to quantify those needs. But just as importantly, kind of like the Boy Scouts motto, they have to be prepared. They have to be prepared when they go in to the bank with their financials so that they can actually be successful winning these loans. And as we already discussed, these capital needs are crucial. Insufficient capital is a huge reason why businesses fail. And as a result, it's therefore that much more important that they understand and are prepared to quantify their numbers. And now at this point, let's kind of transition into the final portion of the presentation. And in this case, we're going to talk about presentation. Now, if we think about presentation, why is presentation really that important? Shouldn't the numbers speak for themselves? And I get asked that a lot. Well, of course, especially accountants. The accountants that I work with say, well, the numbers are the numbers, right? If they can service the debt, they can service the debt. If they have strong revenue growth, they have growth. But at the end of the day, how you say what you say, how you show what you show is critical. Imagine this. Imagine if your significant other and you were sitting, around the Christmas tree, and there was 2 packages under the tree. The first one you had was wrapped in a trash bag with newspaper. How excited would your significant other be to open that package? Secondarily, there's another package right next to it. It's been perfectly gift wrapped, has a beautiful bow on top with a nice handwritten card. Of course, your significant other is going to immediately want to open the nice-looking package. Presentation absolutely matters. What's inside can't replace the presentation by itself, but without proper presentation, it's going to be much more challenging to get the types of access to capital that your clients need. So let's now think about what most businesses are currently presenting. As we can maybe go with this analogy a little bit, maybe they're presenting their financials, their performance in that trash bag. Basically they're just taking their P&L, their balance sheet, etc., maybe from QuickBooks, maybe from whatever general ledger software they use, and maybe they're taking their tax return, whether it's a 1040 Schedule C or whatever it is. They're taking this financial information and then filling out some sort of loan application, and that's about it. And they really think that that's going to help win them the loan. Well, what they miss is the actual presentation of the numbers themselves even is critical in this kind of scenario. Now, before we get into kind of deliverables, let's kind of transition and think from the other person's perspective. We have to think about who they're addressing, i.e. the financial institutions. What do the banks really want to see? Well, from a big picture perspective, banks really want to see, I guess, 3 things. Essentially, who's borrowing the money? Can they pay us? And are we protected? And I know that sounds maybe, cut and dry, but that's because banks are in the business to make money. So at the end of the day, banks really care about these 3 main things. Now, with that said, banks often think in terms of the 5 C's of credit. And I think it's really crucial that our clients understand not only the 5 C's, but then how to adequately demonstrate to the banks that they have those covered. So what are the 5 C's? Well, the first one is character, the personal integrity of the business owners and officers in the business. Number 2 is capacity. Can the borrower generate adequate cash to repay the loan? 3 is, do they have sufficient capital? Are they adequately capitalized, in particular within their industry standards, to withstand an unexpected loss? Next, do they have sufficient collateral? Is there an alternative source of repayment in case of the primary source failing? And finally, what are the conditions? The economic, industry, and market environment is going to change. The question is the borrower flexible enough to adapt? So if we think about what's going to make a successful presentation, we really want to incorporate the necessary things that are going to address those 5 C's, the things that banks care about, the things banks look at, and put it into a way that makes it easy for them to consume. So if we think about maybe if we summarize that even at a higher level, what's really going on? Well, ultimately they want to know the business's ability to service the debt. So we're talking about capacity, capital, and collateral here. And in this context, you as financial professionals are really uniquely qualified to do these types of things. You're the ones putting together write-ups or doing reviews or audits or even just the tax return. But you're also the ones who understand the metrics. You're the ones who are able to put this kind of material together quickly. So, for example, a standard financial statement, income statement and balance sheet and cash flow. Or maybe putting together the debt service and the key metrics, not only, before, but also after that loan is taken out. And putting that into some sort of, one-page overview with the loan and its, terms in there, so that they already have a good sense and a good, feel about your client coming in and asking for the loan. And of course, visuals. You can't get away from the fact that a picture's worth 1,000 words. And really showing them on paper, hey, here's my interest coverage, here's my debt service, and this is what it's doing over time. Now, the second thing, of course, is not just the business, but can the business adapt to market changes? So essentially, the industry and how they respond. And this really reaches out to the conditions. So, you as financial professionals often have access to industry data, whether it's from a variety of sources, as well as your own client base and your experience in that industry. And you can put together deliverables very quickly that show the client's financial health in comparison to their industry. So, with this client up here, we see their current ratio is much stronger than the industry average. Great, visual aid to go along with a loan package to really show meaningfully that your client can, with no doubt, service this debt and will be a going concern into the future. Of course, we may not be able to help them with the character part, but we can really help with the rest. And that's really going to bring success to any loan package. If you can put together a nice set of deliverables and really help coach your client on qualifying their needs, matching those up with their goals and the types of loans available, and then quantifying those and putting them into some nice presentation form. Now, of course, you as that trusted advisor have everything at your fingertips. You have access to their private, sensitive financial information. You have the knowledge base, the expertise, the skills. You really are positioned uniquely among all people in all industries to be really that perfect middleman between small business owners and the financial institutions that they really need to get access to capital from. And that's really what, why we put this whole webinar together, because we wanted to help, our clients really be even more successful in deepening relationships with your clients, as well as ideally increasing your revenue from your existing client base. Now, just as a brief, testimonial here, one of our clients recently used ProfitSense and our suite of tools to help one of her small business clients win a loan, a pretty substantial loan for a small business client, a $1.5 million loan. And we would love to talk with you. I would love to have a chat with anyone on the webinar today. And of course, my contact information will be here at the end. But I'd love to talk with any of you who wants further information about how we can help with your solutions, how we can help provide not only you with the right tools, but also the right guidance as you help your clients win business loans. So with that said, I'm going to turn it back over to Jessica, who has a couple more poll questions at this point.
Thank you, Peter. Before we go into the questions, I just want to say thank you to you for this great presentation. You provided a lot of great information. Before we do open up for questions, I do have two more final poll questions that I'd like to ask. The first poll question is going to be, are you interested in learning how ProfitSense can help you win your business clients' loans? And we'll give it just about a minute here to go ahead and allow you to answer those questions. All right, we still have some answers coming in, so we're going to give it just about another 10 to 15 seconds. All right, we still actually have some responses coming in. If you haven't chosen a response yet, please do so. All right, we're going to go ahead and close that poll question. The last poll question is we're interested and we're thinking about providing a webinar on valuations, and I'd like to see if anybody from today's webinar would be interested in that topic. So if you would be interested in learning about valuations, please go ahead and select yes on your screen at this time. All right, we're going to give it just another few more seconds here. All right. We are about to open it up for questions here. Right now on your screen, you should be able to see our additional resources page. I invite all of you to access our white papers. I will be sending out an email here after the webinar that will include a recording of today's webinar, the slides from the webinar, and also a white paper on this topic. But that link there will allow you to access each white paper that we have that you have access to. We also have a group on LinkedIn called Business Advisory Professionals that I encourage you to join. Within that group, it's going to be a lot of your peers providing best practices. We also have some thought leaders within the accounting industry that participate in the group as well. And then lastly, we recently opened up our database of our industry data that we provide out to U.S. Accounting firms. And that last link there, if you are not a customer, it is a very basic report. It's our most basic report that we offer, but it does allow you to just get a feel for our industry data and to check out the reports to see if it's something you're interested in. So I encourage you to sign up for that, and you can choose any of the industries that you would like. All right, Peter, it looks like we have a couple of questions here. If we aren't able to get through to all of the questions, we will go ahead and get those answered for you after the webinar. The first question is, how much are people typically charging for these types of services?
Great question. Thanks, Jessica. So, good question. we see kind of all over the map. It kind of depends on your purposes and what you're hoping to achieve out of this type of service. You know, it may be a client that you really just want a deeper relationship with, and you may not charge at all, because imagine the value that you're able to provide a client with this type of service. So it may, you know, set you apart from your competition, and it may be a great way to add a relationship that's never going to, you know, they're never going to jump ship and go to a competitor, but more importantly, set yourself up for more engagements in the future. Secondarily, though, we do have some people who bill by the hour for these types of engagements. I would encourage you to consider an alternative method, though. I'd say the clients that I've worked with who are most successful typically use either some form of value billing or project basis here. You know, it may be a standard project where you have a standard fee for this service, which might be, you know, typically I see anywhere between about $1,500 and a few $1,000s. But of course, value billing is typically what I recommend. Start getting paid off of the value you're providing. Start getting paid what your services are actually worth. And of course, if you can get a, you know, $1.5 million loan for your client, it's really going to help them not only survive but thrive. Of course, they'd be willing to pay, you know, a decent amount of money for that. So I really encourage people to try to take on a value billing type model. Now, if there are more questions about the value billing, I'd be more than happy to discuss that with anybody. Feel free to give me a call or email me as per my contact information on the screen. With that said, thanks, Jess. So what other questions do we have?
It looks like we have one last question, and it says, can you tell me more about how ProfitSense can help with this?
Oh, gotcha. You know, at this point, I really wanted to kind of just overview of what we've seen as, you know, best practices. Not really looking to talk about our product. We really want to help our clients see, you know, what's going on in the industry, see what's going on, you know, and how they can match their services with their clients to new opportunities. Of course, I'd be more than happy to talk one-on-one with any of you guys about our ProfitSense suite of tools, but I appreciate the question.
All right. Again, I want to thank everybody for joining and for Peter for presenting today. Again, you will be receiving an email from me shortly that will include a recording of today's webinar, the slides, and a white paper on today's topic. For those of you that answered yes to learning more about ProfitSense, or if you would like to learn more information pertaining to how to help your business clients win loans, please feel free to email Peter. Otherwise, we will be contacting you if you did answer yes to that question. Thanks again to everybody for joining, and please enjoy the rest of your day.